Hello, I'm Finola Burke from RaaS Research Group, and we're focusing on Know Your People RegTech company, KInatico, ASX ticker KYP. Joining me to discuss the company's recent Q4 update is CEO Michael Ivanchenko. Welcome back, Michael.
Great to see you, Finola.
So KInatico reported Q4 revenues of 7.3 million, of which 38% or 2.8 million was SaaS revenue, and SaaS revenue grew by 40% year on year. Are you happy with the pace of growth of SaaS revenue?
Yeah, look, we are, Finola. It's we're in a pretty unique company or unique position, whereas this combination of having an existing product base and, in many ways what I refer to as a legacy product base in the screening brand under CV Check has provided us a ready-made pipeline for customers to talk to about our SaaS product and growth. So it's a tremendous advantage for us to be building that side of the business. But having said that, a lot of the growth we're seeing, an increasing amount, is actually coming from new customers into the pipeline, supplementing it. So to the point where the growth within the recent quarter, I think off the top of my head is moved $300,000 or $400,000 within the quarter. About 40% of that has come from directly new customers that have not engaged with us before. So in terms of that SaaS growth, having that base that we continue to build upon, but also an increasing number of new, gives us that confidence that we've got that right product that is in market and needed in market at the moment, and we're confident about that ongoing growth.
So you've got new customers coming into the business. What's been the response from your existing customer base, Michael, so far? And are they taking up the offer to move to a subscription basis?
Very much so. There's certainly very little, if any, pushback about the idea of moving into digitized and simplified daily compliance. We see some of those organizations in dealing with the change management of rolling out platform may take longer than others, but certainly in terms of confirming market demand, the demand is very strong.
And where are the new customers coming from? From the SaaS perspective, are they coming from government, or is it enterprise, or combination of both?
Certainly the majority of them enterprise, and we continue to see strong growth in healthcare and aged care, but also very strong in government. We'll be announcing soon a number of additional government agencies to the ones we've announced recently, like Department of Aged Care and Health and Families in Victoria. So I take a lot of reinforcement out of the fact that being a product based around not only simplicity but security of private data, and we're getting government agencies coming on board, it says a lot about our approach.
And you've also announced that the company reported full-year revenue of 28.7 million, with SaaS revenue contributing 9.7 million of that, and also NPAT of 0.8 million, which was a threefold increase on FY23 and well ahead of our forecast as well. Is this growth in NPAT a demonstration of the higher margin SaaS revenue dropping through to the bottom line?
Absolutely. Fundamentally, the benefits of inherent in having contracted revenue with customers, but also combined with the results of the investment we've been making in technology and features and functions that has allowed us to move through the value chain with these organisations and provide more of the features and the value for them in simplifying their daily operations, as opposed to what traditionally was just a transactional commodity service. So that that combination is sort of the virtuous cycle of growth in, on the one hand, continuing to build out the value that we provide, but also having those arrangements or those engagements under SaaS contracts leads to that result that we're now seeing.
And you ended 2024 with 10.1 million in cash, which was an increase on the cash you held at the end of FY23. What opportunities do you see for deploying this cash in the year ahead?
That's always the question I get a lot, Finola. And we have big plans for this coming year. What we've done over recent years, quite frankly, is transform a traditional business into one that is forward-looking, growth-oriented, effectively far more akin to a startup. We've been focused on establishing product market fit, making sure that what we were doing resonated, there was market demand, and that we could demonstrate that we could scale that business profitably. We've done that. We now intend to go to the next stage of actually accelerating the growth and reach of that product, and we will be investing in the coming year to make sure that happens. So the focus on self-service and self-deployment for customers, the ability for them to build their own compliance requirements within our platform, all adding to the value of those SaaS agreements, but for us also reducing the time for new customers to actually go live once they've signed the contracts. So now that we've got the business into this demonstrable, scalable, profitable base, we are going to be investing now in demonstrating where we can take that, and on the exciting move now to being a growth story.
And obviously that sounds like you have big plans for organic growth. What about merger and acquisitions along the way?
Always on the lookout. And certainly, we're seeing an increasing amount of activity in the marketplace, both on the acquisition and the dispersal side. If the opportunity comes for us to expand our market reach or accelerate our product deployment, we absolutely would look at it. We have passed on a number of opportunities that have been presented that didn't meet the right criteria. So if the opportunity presents, we'll grab it with both hands, but at the same time, we're also not going to allow it to distract us from the execution that we've got in place now to continue the success we've seen.
Well, thank you, Michael, for your time today. I'm looking forward to catching up with you over the course of the next 12 months to check on KInatico's progress.
Thanks, Finola. Always great to chat.